Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hemoen. In today's episode, we will cover a variety of topics that are sure to keep you informed about the latest developments in the mortgage and real estate markets in Ontario and beyond. From a weekly market wrap to some concerning news about a Toronto law firm accused of embezzling millions from home buyers to the struggles faced by Canadian renters and much more. So, let's dive right in. First up, let's take a look at the weekly market wrap. The Bank of Canada has cautiously started to cut rates, and the Federal Reserve is currently on pause. However, the effects of previous tightening are still filtering through the economy, and early signs of consumer fatigue are beginning to emerge. Cooling demand could help inflation moderate and provide more confidence for central banks to start normalizing interest rate policy. Despite the cautious rate cuts, rising stock market and housing prices have driven household net worth to new records, creating a wealth effect that supports spending. However, it's important to note that the benefit of rising wealth is not distributed equally, and low-income consumers are under increasing pressure. As long as inflation continues to cool and consumers remain employed, the economic expansion and the bull market should continue. It is clear that the consumer has been the linchpin of economic growth over the past 3 years, driving strong momentum in the United States and resilience in Canada. But, as mentioned earlier, the effects of previous tightening are still filtering through the economy, and early signs of consumer fatigue are beginning to emerge in the United States. At first glance, this year's investment and economic conditions would suggest a confident and optimistic mood among consumers. Stocks continue to hit new record highs, with the S&P 500 logging its 31st all-time high this year and the TSX 9. The U.S. economy has been growing at a 2.9% pace over the past 4 quarters, faster than the last decade's average and above its long-term potential. Canada's growth has lagged, but the economy has been able to avoid a recession. Unemployment is low, staying at or below 4% for 30 straight months in the U.S., the longest such stretch since the mid-1960s. Despite these positive indicators, consumers are feeling lousy. In the United States, the University of Michigan Consumer Sentiment Index fell to a 7-month low in June, reflecting a pessimistic view of personal finances and overall business conditions. For perspective, the index is 30% below its pre-pandemic level and only slightly above the 2008-2009 average, when unemployment was north of 8% and the economy was coming out of a severe recession. An alternative measure of how consumers feel is the Conference Board's Consumer Confidence Index. This measure is more influenced by employment and labor market conditions, and as expected, it is more upbeat. Still, the June reading is 20% below its pre-pandemic level. In Canada, consumer confidence has been recovering, but is also weak by historical standards. What explains this disconnect between the solid macroeconomic environment and how consumers feel about the economy? While inflation has slowed dramatically since 2022, consumers are still worried about high prices and find little relief in prices rising more slowly. This is particularly true for low-income households, which disproportionately bear the brunt of inflation due to the high share of their income spent on essentials such as food, gas, and rent. Prices have risen 21% in the United States and 18% in Canada cumulatively since 2020, marking the largest 4-year increase over the past 40 years. It's no surprise, then, that consumers are feeling the pinch from higher expenses. But what about incomes? Wage growth has only recently started outpacing inflation since mid-2023. For the average household in 2021 and 2022, earnings did not stretch far enough. However, United States personal income, which includes government benefits, interest, and dividends in addition to wages and salaries, has grown faster than inflation, up 28% since 2020, thanks to government support and stimulus measures in the early days of the COVID-19 pandemic. But as excess savings deplete, the impact of inflation is becoming more intense. Additional factors dampening consumer sentiment include high mortgage rates and home prices, which have made home buying unaffordable for many, and a gradually loosening labor market. Unemployment is low, but rising. Job openings have declined by a third from peak. Fewer workers are voluntarily quitting jobs, and last week, jobless claims hit their highest since September 2023. The highlight in the economic calendar last week was the release of Canada and United States retail sales for May. In Canada, retail sales posted a gain for the first time so far this year, rising 0.7% in April, which was in line with consensus. However, the preliminary estimate for May suggests that sales retreated again, falling 0.6%. Also, the annual increase in sales remains below the pace of population growth. In the United States, growth was positive but slower than expected, suggesting that consumers are exercising more caution amid tighter budgets. Specifically, headline sales rose 0.1% from the prior month versus the consensus for a 0.3% rise, while April's data were revised lower to a 0.2% pace. Control group sales, which exclude some of the volatile categories such as gas and vehicles, and feed into the consumer spending component of GDP, rebounded 0.4%, but April's decline was revised downward to a 0.5% monthly drop. From a year ago, control group sales are 3.1% higher, only slightly below the last 20-year average, and around the 2019 pace of gains. The key takeaway is that consumption growth is slowing as high borrowing costs and high prices bite, but this process can be described as a normalization after a period of splurging rather than something more ominous. Therefore, it's a yellow flag and not a red one in our dashboard. Now that pandemic-accumulated savings are exhausted for a large share of households, and with high interest rates limiting the desire to borrow, consumer spending will likely be dictated by the growth in real incomes. However, changes in income are not the only driver of consumption. Rising stock market and housing prices create a wealth effect that tends to support spending even if incomes do not change. That is because consumers feel more confident to lower their savings rate if their assets have increased in value. The good news is that household net worth rose to $160 trillion in the United States in the first quarter, an all-time high and up from $148 trillion a year ago. Of that $13 trillion increase, $7 trillion came from equity holdings appreciation and $3.3 trillion from real estate appreciation. Moreover, the sum of checking deposits, savings deposits, and money market funds is 27% higher than in 2019 in nominal terms and 13% in real terms after adjusting for inflation. However, the benefit of rising wealth is not distributed equally. The top 10% of United States households by wealth own 87% of equity holdings and 44% of real estate. On the other hand, the bottom 50% owns just 1% of equities and 11% of real estate. Overall, consumers remain well supported, but there are signs that some are having more trouble managing their debt in this high interest rate environment. Serious delinquency rates for credit cards and auto loans in the United States are at their highest level in a decade, suggesting that low-income consumers are under increasing pressure. Nonetheless, the lion's share of household debt is home mortgages, and delinquencies there remain historically low and below the pre-pandemic level. Consumer spending growth is gradually shifting from a robust pace to a more moderate one. With personal consumption responsible for about 2/3 of all economic activity, GDP growth will also downshift, providing more confidence for the Federal Reserve to begin cutting interest rates later this year and supporting the Bank of Canada's pivot to lower rates. Current market pricing implies a 60% chance of a Federal Reserve September cut, followed by one more in December, and a 60% chance of a July Bank of Canada cut, followed by another in December. Regardless of whether the Federal Reserve cuts one or two times this year, the bigger picture is that, like the Bank of Canada, it will likely be embarking on a multi-year rate-cutting cycle to normalize policy. The past 4 years showcase the importance of holding appreciating assets during an inflationary period, helping investors maintain their purchasing power. Record net worth in both nominal and real terms will keep supporting households and spending. Despite the pressure on low-income consumers, the relative performance of the S&P 500 discretionary versus staples sector is not hinting at any broader stress. In Canada, discretionary stocks have lagged, potentially reflecting the weaker outlook for the more indebted domestic consumer. However, the relative consumer sector performance has been more range-bound recently. As long as inflation continues to cool and consumers remain employed, the economic expansion and the bull market should continue. Unlike consumer sentiment, Investor sentiment is very optimistic, driven by a boom in artificial intelligence stocks. Last week, Nvidia unseated Microsoft as the world's most valuable company, with a market capitalization 30% larger than the entire small-cap universe. Excitement around artificial intelligence is driving market concentration higher, but is also increasing the risk that a mania may develop. We think that diversification is still important, as it can help manage risk and potentially enhance returns as the start of a Federal Reserve easing cycle approaches. To wrap up this weekly market segment, let's take a quick look at the weekly market stats. The TSX closed at 21,555 with a weekly change of 0.4% and a year-to-date change of 2.8%. The S&P 500 index closed at 5465 with a weekly change of 0.6% and a year-to-date change of 14.6%. The MSCI EAFE closed at 2,328 with a weekly change of 0.9% and a year-to-date change of 4.1%. Canada investment grade bonds had a weekly change of 0.3% and a year-to-date change of 0.4%. The 10-year Government of Canada yield was at 3.34% with a weekly change of 0.1% and a year-to-date change of 0.3%. Oil prices were at $80.63 per barrel with a weekly change of 3.3% and a year-to-date change of 12.5%. Lastly, the Canadian dollar to US dollar exchange rate was 0.73 with a weekly change of 0.4% and a year-to-date change of 3.8%. In a shocking turn of events, a husband and wife law firm in Toronto is facing multiple lawsuits and a police investigation after allegedly embezzling millions of dollars from homebuyers' trust accounts. Nicholas Cartel and Singa Bui, partners of Cartel and Bui LLP, are accused of failing to pay off sellers' mortgages in at least 6 Southern Ontario home sales, despite receiving funds from buyers to do so. The Law Society of Ontario has provisionally suspended both lawyers and shut down their firm amid 15 lawsuits claiming a total of $15.5 million in damages. The cases have exposed a significant vulnerability in the home buying process that relies heavily on lawyers' undertakings and good faith. According to lawsuits filed by 7 home buyers, the firm allegedly took their money, paid out the home equity to sellers, but held on to the remaining funds meant for mortgage payoffs. The general public needs to know that their money isn't safe in a lawyer's trust account, Anthony Ngara, a mortgage agent who lost over $310,000 in dealings with the firm, told CBC News. In another case, Thierry Cohen-Scali, a Florida-based engineer, alleges the firm is withholding $465,000 meant to be returned to him after obtaining necessary tax clearances from the Canada Revenue Agency. Balvinder Kumar, a veteran real estate lawyer, highlighted the risks associated with wire transfers in property transactions. Wire transfer has become a norm, and that is very risky because in spite of the fact that the lawyers are giving undertakings, it may or may not happen. Court and Law Society documents suggest the couple used clients' funds to pay their own mortgages, credit card bills, and business taxes. The judge described their lifestyle as fairly extravagant, with Cartel requesting monthly living expenses of $30,055. While Bui initially shouldered the blame for the missing funds, Cartel maintains he had no role in financially managing the firm. However, the Law Society's decision to suspend him states he appears to have misled another lawyer and failed to cooperate fully with investigations. The Law Society of Ontario has faced criticism for its delayed response to complaints about the firm. Despite reports of financial irregularities dating back to April 2023, an audit of the firm's bank accounts only began in late November. Cartel has repeatedly promised to make whole those who have lost money, but there is little evidence of follow-through. He is appealing his license suspension and claims to be in discussions with the Law Society about resolving his case, a statement the Law Society representative has flatly denied. Many Canadian renters do not plan to purchase a home in the near future, with affordability challenges being a significant factor. A recent Royal LePage survey found that 69% of renters do not intend to buy a home soon. Among those who do plan to buy, the greatest barrier to entry is accumulating sufficient funds for a down payment. While a third of Canadian adults are currently renting, and there are families who are perfectly content doing so, the desire for home ownership remains strong among a large portion of this segment of the population, said Royal LePage Chief Executive Officer Phil Soper. Our latest research reveals that many renters wish to transition to home ownership. Understandably, the greatest barrier to entry is the ability to drum up the initial capital for a down payment. Before signing their current lease, nearly one-third, 29% of renters considered buying a home. However, 41% cited the lack of a sufficient down payment as the reason for opting to rent instead. The rental sector is not immune to the significant affordability challenges stemming from Canada's acute housing shortage. High mortgage rates have made it difficult for many to purchase a home, forcing some to move into or remain longer than planned in the rental market, Soper said. The survey also highlighted other factors influencing the decision to rent. About one-third of respondents are waiting for interest rates, 33%, and property prices, 30%, to decrease. Additionally, 22% are renting while saving for a down payment, and 20% did not qualify for a mortgage. Earlier this month, the Bank of Canada announced its first rate cut in more than 4 years. Falling borrowing costs will lower the threshold to qualify for a mortgage, helping renters become owners, Soper added. However, this creates a double-edged sword. Increased competition as they enter the market will put additional pressure on property values. While some will wait for home prices to become more reasonable, Canada's housing shortage will leave them waiting indefinitely. Many renters are looking to bridge the down payment gap through various means. 53% plan to use savings, 46% will take advantage of the First Home Savings Account, and 29% will draw on their registered retirement savings plans using the Home Buyers Plan. While affordability challenges may force relocation for some, the survey suggests many are willing to consider moving to a more affordable city, particularly young adults and those with remote work options. According to the report, 50% of residents in Toronto, Montreal, and Vancouver would consider relocating for a more affordable home. The high cost of rent adds another layer of strain for Canadians. Nearly 73% of renters spend between 31% and over 50% of their income on rent, with major cities like Vancouver and Toronto seeing a significant portion of renters spending more than half their income on housing. In response to these challenges, the 2024 federal budget announced several measures to protect tenants and support their path to homeownership. These include the creation of the Canadian Renters' Bill of Rights and a proposal for financial institutions to allow tenants to report their rental payment history to credit bureaus to improve their credit scores. It is no secret that Canada's mortgage market is bracing for a wave of renewals in the next 2 years, with the country's top bank regulator recently flagging the risks posed to the financial system by that coming trend. Last month, the Office of the Superintendent of Financial Institutions raised the prospect of persistent high interest rates, contributing to a significant payment shock for borrowers upon renewal. Borrowers with variable rate mortgages, whose payments are fixed, especially those already in negative amortization, are of specific concern to the regulator. There is undoubtedly some sticker shock on the way for many Canadian borrowers upon renewal. However, a leading Greater Toronto area-based mortgage executive is calling for market watchers to view the current landscape in context, with Canada Mortgage and Housing Corporation estimating the 25-year average for a 5-year fixed mortgage rate at 5.21%. Sung Lee, managing partner at the Swivel Mortgage Brokerage, told Canadian Mortgage Professional that while many observers have anchored their views in the ultra-low mortgage rates that have prevailed in recent years, those historical averages suggested the rate environment of today was far from unprecedented. What that indicates is that rates are not terrible from a historical perspective, he said. Rather, we need to recalibrate borrower expectations. Mortgage rates in the 4 to 5% range will be the new normal for the foreseeable future. It goes without saying that securing the best possible rate for clients has always been a key consideration for mortgage brokers in any environment. Still, the coming turbulence means the onus is also on brokers to provide as comprehensive a slate of services as possible for borrowers to guide them through that economic uncertainty, according to Lee. One thing is being able to provide clients with a competitive rate or a really good rate, he said. But I think in this environment, clients are looking for much more than that. They are looking for someone who can guide them, dig deep into helping them create a proper budget, see where they can find some savings to offset some of those increased payments that everybody is seeing. In its latest State of the Housing Market report, Mortgage Professionals Canada found that 44% of mortgage holders accepted the initial rate offered by their lender during their last renewal, a jump of 3% from last year, with a mere 8% indicating that they had significantly negotiated their new rate. That can be for a number of reasons, according to Lee, not least a feeling of being handcuffed, as those borrowers may not requalify with a new lender if they have seen their overall debt increase while their income has remained somewhat stagnant. Lee said brokers again have a responsibility in those instances to make sure their marketing is tailored to individuals in similar situations, making sure those borrowers are getting a second opinion on whether the renewal offer is competitive. A good broker will tell you if it is a good deal, he said. If not, we will find something better that they can qualify for. So I would say, nonetheless, you always want to make sure, from a client perspective, that you are getting a second opinion, and from a broker perspective, that you are actively reaching out to individuals to make sure that they know what the best option is, so they are not leaving $1,000 on the table. Mounting affordability challenges in recent years amid that higher rate environment have seen plenty of borrowers left with little option but to gravitate towards the alternative lending space, having been priced out of more traditional lending options. Lee said the mortgage spectrum had been represented across Swivel's client base of late, with around 50% on the A side, approximately 30% on the B side, and around 20% in the private mortgage space. There is a mix we are seeing, he said, including people who have previously qualified for A financing, having extended ratios, and having to shift over to a B lender with the hopes that they will be able to get them back as rates continue to decrease. In a major development in the mortgage industry, digital mortgage lender Nesto has announced its acquisition of CMLS Group. This significant deal will merge two companies that together have over $60 billion in combined mortgages under administration, creating what Nesto describes as the largest technology-enabled lender in Canada. The acquisition is backed by investments from notable partners, including Diagram Ventures, Portage, Bank of Montreal Capital Partners, and the corporate venture capital arm of National Bank Ventures. Malik Yacoubi will lead the combined entity as Chief Executive Officer, while CMLS Chief Executive Officer Sam Brown will head the commercial division. In a statement accompanying the announcement, Yacoubi emphasized that the deal reinforces Nesto's commitment to delivering on its mission: to offer a positive, empowering, and transparent property financing experience, simplified from start to finish, to all Canadians. The acquisition adds a long-established player in the mortgage market to Nesto's portfolio. CMLS began as a commercial lender in 1974 and has since developed into a prominent part of Canada's commercial and single-family residential real estate markets. The merger is expected to accelerate CMLS's next chapter of growth and further support its people, partners, and clients. Both companies have stated that their individual brands, Nesto, CMLS, and Intellify, will remain intact following the merger, allowing them to continue offering specialized services under their established names. This acquisition marks a significant milestone in the Canadian mortgage industry, and it will be interesting to see how this merger influences the market in the coming months. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found these topics informative and insightful. Stay tuned for our next episode, where we will continue to bring you the latest news and developments in the mortgage and real estate markets. Until then, I am your host, Steve Hamoan, wishing you a great day.